The usual sunny optimism that permeates this island nation at the bottom of the world has taken on a distinctly gloomy hue of late. As economic storm clouds gather, a palpable sense of anxiety has set in among New Zealand's business community about the path ahead. The latest data from the New Zealand Institute of Economic Research paints a sobering picture. A striking 44% of firms surveyed expressed outright pessimism about the economic outlook over the next 6 months, nearly double the 25% level recorded just 1 quarter earlier. This encroaching climate of negativity is the highest such measure in over a decade. Beyond the corrosive psychological effects of such dire sentiment, hard evidence points to real and rapidly deteriorating conditions on the ground. Over 1/4 of businesses reported their trading conditions had worsened during the first quarter of 2023, the worst such reading since the dark days of 2020, when the COVID-19 pandemic rocked the global economy. These grim leading indicators raise the specter of New Zealand slipping into an economic contraction during the coming year, which would mark an alarming 5th recession in just a 7-quarter span. For a small, trade-dependent nation, such a scenario is particularly perilous given the fragile state of the world economy amid high inflation, tightening financial conditions, and geopolitical instability. The signs are unmistakable that storm clouds are gathering over the New Zealand economy, said Christina Leung, chief economist at the NZIER. Prepare for a potentially turbulent ride ahead. At the heart of the current malaise is the aggressive interest rate tightening campaign pursued by the Reserve Bank of New Zealand over the past year in its battle to tame runaway inflation. Policymakers lifted the official cash rate at a blistering pace from a record low of 0.25% in April 2022 to the current level of 5.5%, the highest since the global financial crisis. While this forceful monetary policy reset has succeeded in taking the steam out of rampant price pressures, services inflation is finally showing signs of moderating. The lagging effects are now making themselves felt across the real economy in the form of squeezed profit margins, elevated borrowing costs, softening demand, job cuts, and evaporating investment. The NZIER survey highlighted the harsh new realities confronting Kiwi businesses. 1/4 of firms were forced to reduce headcounts, the biggest workforce purge since 2009 when New Zealand was emerging from the global financial crisis. And looking ahead, a net 10% of respondents plan further staff cuts over the coming 3 months. Perhaps most alarmingly from a longer-term perspective, businesses are aggressively paring back capital spending plans in the face of dimmer sales prospects and tightening credit availability. Capital is the seed corn for future productivity gains, innovation, and competitiveness. Slashing investment today plants the seeds for anemic growth down the road. New Zealand is renowned for its world-class agricultural exports and tourism offerings. The concerning downturn in business sentiment raises worrying risks that the nation's economic calling cards could become tarnished by deteriorating conditions domestically and weaker global demand. The land of the long white cloud is staring down its biggest challenge since the depths of the pandemic, said Mark Smith, senior economist at ASB Bank in Auckland. There is a very real possibility the central bank may need to start cutting interest rates sooner than currently projected to prevent a hard landing. Indeed, the urgency of the situation has markets now fully pricing in interest rate cuts before the end of the year. Most private sector economic forecasters see the Reserve Bank relenting and lowering borrowing costs in early 2025 to provide some relief. However, the central bank itself continues to insist it sees no compelling case for monetary easing until late 2025 at the earliest. Officials remain laser-focused on securing hard-won inflation gains amid still tight labor markets and lingering price pressures, even at the risk of inflicting excessive economic pain. Caught between stakeholders anxious for a respite from ever-higher borrowing costs and the threat of emboldened inflation psychology becoming re-entrenched, the Reserve Bank of New Zealand may soon find itself facing a difficult choice between 2 ill-fated scenarios, stoking a deeper downturn or losing its hard-won credibility. Which path policymakers ultimately choose will have profound ramifications for the trajectory of the New Zealand economy over the coming years. For the legions of hardworking Kiwis barely emerging from the pandemic's hardships, the stakes could not be higher. After all, a little ray of sunshine can make all the difference when one stares down an ominous bank of storm clouds on the horizon.